Ladies and gentlemen, good day and welcome to the Max Estates Limited Q3 and 9 months FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. This conference may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company. As on date of this call, these statements are not the guarantees of future performance and involves risks and uncertainties that are difficult to predict. And a disclaimer to this effect has been included in the financial results and investor presentation, which has been shared with you earlier and available on stock exchange website. I now hand the conference over to Mr. Sahil Vachani from Max Estates Limited. Thank you and over to you, sir.
Thank you and good afternoon to all. Thank you for joining us on this Max Estates Q3 and 9 months FY24 earnings conference call. Along with me today, we have Rishi Raj, who's our Chief Operating Officer, and Nitin Kansal, who's our CFO. We also have SGA, our Investor Relation Advisors, on the call. The presentation and press release has been issued to the stock exchanges and uploaded on our company's website. I hope everyone has had the opportunity to go through the same. To begin with, I'd like to highlight a few broader trends from our perspective. Despite global uncertainties, the Indian economy continues to be resilient and on an upward trajectory post-COVID. As India progresses from a $3 trillion to a $7 trillion market over the next decade, over 400 million people who will reside in urban centers, and amongst home ownership capable population, the upper mid and high income segment will grow from 26% to 45%. Rising income, favorable affordability, and rapid urbanization will continue to fuel housing demand in the urban and metropolitan centers. Changing consumer preferences with a focus on quality and overall experiences backed by an ecosystem of amenities, services, and generous spaces, particularly amongst millennials between the age bracket of 25 to 40 years, is giving a strong fillip to end-user demand for premium housing launches by organized and corporate developers. Contrary to developed economies, return to office is in full swing in India across sectors. From fully remote to hybrid, and now office-led hybrid is fast becoming the norm. This, coupled with a flight to quality with a focus on employee experience, has further accelerated the K-shaped recovery for commercial office segment in India, which is a favorable trend for institutionalized players with build-to-lease model bringing online grade A+ sustainable developments. Amongst the top regional clusters, real estate sector in the Delhi NCR region is poised for significant growth with continued urbanization and expansion of the region at the back of significant emphasis on infrastructure development, cutting across roads, airports, metro lines, as well as social amenities, including hospitals, schools, hotels, and other facilities. Before I hand over to Rishi for the business updates, let me share what are going to be the key areas of focus for us at Max Estates as we look forward. First, regarding growth, Max Estates has demonstrated remarkable prowess in expanding its commercial and residential real estate portfolio across the Delhi NCR region. Following successful ventures in commercial development within Delhi and Noida, the company has judiciously ventured into residential developments and entered the Gurugram real estate market. As we strive for the next phase of growth, Max Estates is committed to scaling its current portfolio, which spans 8 million square feet, by adding 2 million square feet to its portfolio every year. In FY25, our primary focus remains on augmenting our residential vectors within the NCR region through joint development as a preferred model and outright purchase in selective cases. Secondly, in terms of capital, since inception, Max Estates has successfully raised over 3,000 crores of capital encompassing both equity and debt. Multiple commitments made by our partner New York Life Insurance, amounting to approximately 800 crores, underscores our ability to partner with best-in-class capital providers and inspire them for a long-term relationship. With cash on our balance sheet, internal accruals from the sale of our first residential project, Estate 128, the lease rental discounting potential of both our new developments, Max Square and Max House Phase 2, coupled with exploring joint development and joint ventures as preferred route to grow, leveraging our brand equity, we are well funded to secure development opportunities, and meet our growth aspirations of 15 to 20% in terms of booking value over the next 3 to 5 years while continuing to build a robust rental portfolio. Thirdly, Max Estates places utmost importance on execution excellence characterized by timely project delivery, superior construction quality, and efficient project management, all geared towards maximizing customer satisfaction, particularly through our live well and work well philosophy. Lastly, there is a deep focus on sustainability, with all our buildings being certified gold or platinum for both green as well as health and well-being aspects. On broader ESG journey, we have secured a 4-star rating in GRESB ranking in 2023 and aim to achieve the highest 5-star rating in 2024 just in the first few years of our journey. With this, I hand over the call to Rishi, our COO, for detailed business updates. Thank you.
Thank you, Sahil, for the strategic overview. Let me first give you project-wise business updates and then move on to the development pipeline. Let us start with our work well experiences. First, quick highlight on the industry. Despite global headwinds, the office market displayed resilience in 2023, witnessing growth in leasing activity on a quarterly and yearly basis. Net leasing in 2023 stood at 42 million square foot, 10 to 11% higher than in 2022. This marks a new post-COVID milestone, second highest annual net office space absorption, only 10% behind 2019 peak. As a result, the sector is poised for a better than expected year on the back of steady occupier confidence. Net absorption for 2024 expected to track in the vicinity of 2019 levels and at least 20 to 22% higher year on year. Supply pipeline is expected to remain strong, with flight to quality a key theme creating demand polarization. Coming to our individual assets, Max Towers, total leased area owned by Max Estates in Max Towers is 100% occupied, and lease rental income from Max Towers stood at INR 280 million in 9 months of FY24, which is estimated at 400 million for full year. Moving on to Max House Phase 1, it is 100% occupied, and the lease rental income from Max House Phase 1 stood at 105 million in 9 months of FY24 and estimated at 160 million for the full year. So between Max Towers and Max House Phase 1, we already have 560 million of annual rental income. Coming to Max Square project, it is already 55% leased at a premium of 25 to 30% over prevailing market rates in micro market. The lease rental income from Max Square stood at INR 6 million in Q3 FY24 and 51 million in 9 months of FY24. The company is confident of achieving 100% leasing in calendar year 24, which will be within 2 years from its completion in February 23. The lease rental income from Max Square is expected to be at INR 600 to 700 million once fully leased. The company has received occupancy cum completion certificate for Phase 2 of Max House in November 2023, a boutique office campus in Okhla, South Delhi. This phase of the development has a net leasable area of 1.5 lakh square feet. When combined with Phase 1, the campus has approximately 2.55 lakh square feet of leasable area. We are happy to share that for Max House Phase 2, 65% of total leasable area already has been transacted, including LOIs, with more than 50% pre-receipt of occupancy certificate. The transacted rentals are at premium of 35 to 40% over prevailing market rates in micro market. In fact, we have been able to derive premium of 15 to 20% over phase one, clear testimony to curating unparalleled campus-like ecosystem with dedicated amenities block at its core. The company is confident of achieving 100% leasing within calendar year 2024, which will be within a year from completion. Lease rental income from Max House Phase 2 is expected to be INR 250 to 300 million once fully leased. Now, coming to Max Square 2, Noida, the company's SPV had successfully won the bid for two land parcels for a total cost of INR 220 crores. Both land parcels combined spread across 4 acres and are located in Sector 129, Noida, on Noida Greater Noida Expressway adjacent to Max Square development, which is now operational. The total development size of the acquired land parcel, including completed Max Square project, will entail a mixed-use total office-led space development of 1.8 million square foot. The company is on track to finalize design and all approvals to start the construction towards the end of Q4 FY24. The lease rental income from Max Square 2 is expected to be in the range of 1,000 to 1,150 million at 100% occupancy. Finally, coming to Max 65 Golf Course Extension in Gurugram, which is a 7.15-acre land parcel with development potential of 1.6 million square foot, located right on one of the most primary commercial office vector golf course extension and is at 10 minutes driving distance from Sector 56 metro station on Golf Course Road. We have Gensler, a global design and architectural firm, as a design partner for the project to bring on board world-class office experience to Gurugram. The lease rental income from this project at its peak occupancy is expected to be in the range of INR 1,600 to 2,000 million. Now, let me move to our lived well experiences. First, a bit on the industry. Housing sales in top 7 cities in India witnessed year-on-year surge of 31% to all-time high of 477,000 units so far in 2023, breaching the previous high of 2022. And 446,000 new units got launched in 2023, implying an annual increase of 25%. Focusing on Delhi NCR, new supply was at 37,000 units against a demand of 66,000 units, translating into significant reduction in inventory by 25% to less than now 20 months, and one of the highest increases in price by more than 50%, making average price in Delhi NCR even surpass Mumbai metropolitan region as per Nuvama research report. While Pan India witnessed share of luxury and ultra luxury launches as per Anarog increased from 9% in 2018 to 24% in 2023, the share in Delhi NCR once again was highest at 38%. Coming to Max Estates portfolio, the company's first luxury residential, Estate 128 in Noida, has received, as we already shared earlier, thumping response, fully sold, and garnered a booking value of 1,800 plus crores. We are delighted to share over last 6 months, the company has collected rupees 441 crores for the project. The payment schedule for this project is construction linked, translating into 25% collection every year, and we are well on track. The construction has begun and is on track to deliver the occupancy well within RERA promised timelines. The company, as we have shared earlier, entered into joint development agreement in Sector 36A, Gurugram, with a development potential of 2.4 million square foot. And at the time, in early 2023, we underwrote the gross development value of 3,200 crores. The land parcel, it measures 11.8 acres with direct access from Dwarka Expressway. The company has onboarded Antara Senior Living for advisory services for its first intergenerational community to be developed on this particular site. The development allocates 33% of available FAR, which is one-third, for the creation of senior living units and associated amenities. Once again, here we have partnered with Gensler to bring to life this community with unique blend of public and private places dotted with high-intensity landscape. The launch is estimated to be in mid-calendar year 2024, and we are well on track. We endeavor to scale this portfolio beyond 8 million square feet by adding at least 2 million square feet per year on an average to the portfolio while maintaining a distinctive source of differentiation, which is design and hospitality-led consumer experience. Finally, coming to mixed-use development enabling both work well and live well experiences, the Honorable NCLT New Delhi approved the resolution plan of Delhi 1. Just to recap, it's a commercial plot measuring 35,000 square meters located in Noida Central Business District. This has a potential of 2.5 to 3 million square foot of additional development footprint to the portfolio of Max Estates beyond 8 million, which we have already secured. The implementation of resolution plan is subject to receipt of requisite approval from regulatory and statutory authorities, which is expected to progress soon. Now, moving to our in-house asset management vertical, Max Asset Services, which provides end-to-end managed office service, including but not limited to fit-out leases, fit-out design and build and office operations services, including F&B, housekeeping, and IT services. We're happy to share that our managed flexible office offering WorkWell Suites at Max House Okhla continues to be 100% leased. As a part of our WorkWell philosophy, we continue to differentiate our client experience by adding more amenities like salon, early learning center, shuttle services, badminton courts, and many more. We continue to curate and evolve various F&B options to create a unique ecosystem for our clients to work well. With an aim to uplift our assets with best-in-class facilities and becoming more operationally efficient, we are deploying various digital tools across all verticals, including parking management, lift management, amenities booking, visitor management, and air quality monitoring. Revenue for Max Asset Services for 9 months FY24 stood at INR 232 million. We expect facility service business of Max Asset Services to witness strong growth in FY24 and FY25 as high percentage of our offices are now open and expected to avail our services. Over years, Max Estates has stayed true to its commitment of creating spaces that enable well-being with an unwavering focus on live well and work well as our philosophy. With this, I hand over the call to our CFO, Nitin Concall, for financial updates.
Thank you, Rishi. Good afternoon, everyone. Now, let me first give you the financial highlights for the 9 months ended for the financial year 24. Consolidated revenues stood at rupees 629 million for the 9 months. Consolidated EBITDA stood at INR 100 million for 9 months FY24. Consolidated profit before tax stood at a loss of 614 million and our PAT stood at a loss of 524 million in the period. This is primarily on account of following. The company has incurred advertising and marketing expenses to the tune of 184 million in 9 months for the launch of Estate 128 project, which is accounted as an expense in line with the accounting principles, while revenue for the same would be recognized subsequently at the time of possession. Similarly, the company has also decided to conservatively take a 100% one-time provision on the investments made in the Azure Hospitality. The provision is for rupees 445 million in 9 months FY24. No provision was made in the quarter three. Furthermore, the company post this provision, the company has got no further non-core investments. Adjusted EBITDA and PBT in 9 months FY24, excluding the above two expenses, would have been a profit EBITDA of 284 million and a PBT of 10 million respectively. Speaking about the liquidity position, the debt stood at rupees 767 crores as of December 2023, of which around 338 crores is LRD. Cash and equivalents stood at rupees 444 crores, hence the net debt stood at rupees 323 crores. Now I would request Tushar to open the floor for the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Shah from Opal Securities. Please go ahead.
Am I audible? Hello?
Yes, sir.
Yeah. So, sir, I have first question would be, what are the risks or challenges do we see on our existing or upcoming projects, if you can help over there? Hello?
Yes. Thank you, Ravi. In terms of risk and challenges, I think one of the risks that we had been witnessing was global slowdown with respect to office leasing, which did have some impact on India as well. But thankfully, unlike developed economies, the return to office phenomena is back in full swing, and we are moving away from remote to hybrid, and now office-led hybrid is one of the options. Pan-India, we see 70% occupancy back in office. When we look at our development, Max Towers, Max House, upwards of 90% is back in office. So I think what we are going to witness is the flight to quality and accelerated K-shaped recovery that Sahil talked about. And in a way, with our philosophy and the development that we endeavor to do, which is anchored on quality and experience for end user built to lease, we see a favorable opportunity for us to move forward as we bring online our 2 new commercial development. I think that's one. I think second, there has been a lot of discussion with respect to housing cycle. In our view, given the fundamental strength of Indian economy that Sahil talked about, also given what we are seeing in terms of change in income mix, rapid urbanization, higher affordability, expected decline in mortgage rates, we believe that the demand for housing is here to stay and going to grow for urban and metropolitan center. The share of luxury and premium is here to stay and continue to grow. So from a price realization perspective, we don't see the challenge. Having said that, we do embrace and agree that the cycles will be much more volatile than we have seen in past. And hence, we as management team, as we're underwriting new projects, taking through cycle view, and instead of assuming that it will be day one, week 1 month sold out, we underwrite conservatively that the sale will happen over the life cycle, and we then calibrate the go-to-market strategy given the market sentiment once we launch a new project. Finally, as we are scaling up from 2 million to 8 million, and now we will continue to grow 2 million, one can obviously say we will have our own execution risk and challenges, which we are trying to mitigate by very, very strong emphasis on people, systems and processes, digital, not just to do lip service, but in true sense, investing significant amount of management time, bandwidth, and effort to build strong foundation and muscle to navigate through volatility in cycles. So that's how I would summarize some of the risks and challenges and what we are trying to do to mitigate it.
The line for the current participant has been disconnected. Moving forward to the next question. Before taking the next question, we would like to remind participants that you may press star and 1 to ask questions. The next question is from the line of Karan Khanna from Ambit Capital. Please go ahead, sir.
Team, thanks for the opportunity. Just a couple of questions from my side. Firstly, Sahil, you spoke about the K-shaped recovery that you're seeing in the commercial real estate space. So if you could quantify in terms of, say, if you look at the RFPs in the market, how has that trended in terms of mix or shift towards the premium segment over the last few years, especially post-COVID? If you could talk more on that. And likewise, on the residential front, given that we've entered CY24 and as we enter FY25, what kind of transactions in terms of the land deals or arrangements with your landowners, what trends are you seeing over there? That's question number one.
Hi, Karan. I'll take this up. Glad to hear you. First on K-shaped recovery, if you look at 42 million square foot of 2023, which is 10 to 11% above 2022, I will call out a few trends that we are witnessing. Clearly, there is flight to quality, which we are witnessing in our recent development, which got completion, both Max Square and Max House. And we are also seeing that in build-to-lease premium building elsewhere in Delhi NCR. Just to illustrate the point, if you look at Max House Phase 2, we got completion in November 23. The building is already 65% transacted. The rentals that we are getting is 35 to 40% above the micro market and 15 to 20% above the Phase 1 development. Similar trends we are seeing for Max Square. But what is interesting is when you peel the onion, there are several other trends that is getting unveiled. Number one, the share of IT/ITES, which used to be around 37%, 2017-19 has fallen to 21%, and that is getting replaced by demand from financial services, engineering and manufacturing, healthcare, flexible office, consulting firm. When you go even one level deeper, what is even more interesting is across sectors, the rise of global capability centers who account for 35 to 40% of leasing absorption, who have much higher appetite for premium and well-managed, amenitized, serviced office building for their employees. Another very interesting trend that we are seeing is shift from US to India to lead to domestic players who are accounting for now almost 44% of the total leasing absorption, and the share of US has gone below 40%. And this is again what we are seeing in our pipeline for Max Square and Max House, lot of domestic players who are looking to upgrade or looking for expansion into a well-managed and premium office building. One of the fallout of this particular trend is that the mix is more gravitating towards smaller transactions. So if you look at 2023 data, up to 51,000 square foot, 41% of the leasing was in that particular category. So these are some of the trends that we see, which we think is favorable for players like us. Quickly, coming to your residential question, as we have announced, our aspiration is to add 2 million square foot. We, at this point in time, are evaluating 15 to 20 deals. 6 of them are in commercial negotiation or due diligence stage, which in itself is around 14 million square foot. Many of these are in Gurgaon, and a couple of them are in Noida and Delhi as well. We are very confident that in first half of fiscal year 25, we will be able to close at least one, if not two more opportunities to meet our growth aspiration.
Sure. This is helpful. Thanks for the elaborate response, Rishi. Second question on your Estate 360 launch. So I understand you're looking to launch this in first quarter of FY25. Could you elaborate, reiterate more in terms of the size of the phase-wise launch pipeline in terms of how you're looking at launching this project?
Yes. So Estate 360, mid of this year, end of quarter one FY25 is what we are targeting. In terms of design closure and approval, we are on track. As we have shared earlier, this is the total development potential here is 2.4 million square foot. Its first intergenerational, one-third will be dedicated to senior living, which will coexist as a part of larger ecosystem. As far as launch size is concerned, as we have shared earlier, we so far were planning to launch it in two phases. At least two-thirds we would like to launch in phase one, and one-third subsequent to first phase launch. The timing will depend on how the first phase launch goes. So that's how we are thinking about the launch of Estate 360. As far as pricing, payment plan, and other details are concerned, we will come back and update all of you once we have gone through all the approvals, including RERA.
Sure. This is helpful. I'll come back in the queue for any further questions. Thanks, Rishi.
Thank you. Thank you, sir.
Thank you. And the next question is from the line of Jia Shah from Well Securities.
Hello. Am I audible?
Yes, please.
Okay. So my question is on the residential project Estate 128 front that we have in Noida. As we are fully sold out, when will we be recognizing the revenue for it? And can you share the timeline for the same? And I also have a second question with respect to the targets for revenue and profitability for FY25 and 26.
Sure. Good afternoon. This is Nitin Kansal. So as per the accounting principles, we have to recognize the income in the year in which the delivery happens. We have sold this unit, residential project Estate 128 in FY24 in June, July of 23. And as per the timelines given to the customers from there, we have been given them a time of 5 years. So we're expecting the revenues to be accounted for in the FY28 for this project. This is when this accounting will come on. I'll hand over to Rishi for the next question.
Okay. So in terms of guidance and longer term trajectory, I would like to call out a few things. First, on commercial real estate portfolio, as we have shared earlier as well, once entire 4 to 4.5 million square foot is fully online and at peak occupancy, this has a potential of 400 to 475 crores of annuity income. Coming to residential, I think a better way to gauge performance and growth in residential is by focusing on booking value. In FY18, we have already registered a booking value of 1,800 plus crore. Given what we have in pipeline with Estate 360, we are expecting a booking value in the range of 22 to 2,400 crores in FY25. And we would like to maintain a 15 to 20% growth trajectory, and in 5 years by FY29, look at annual booking value in the range of 4,000 to 4,500 crores. In order to deliver on this growth aspiration, if we work backwards, our acquisition targets that we have shared, which is 2 million square foot per year, is reasonable to address and deliver on this growth target. And at the same time, given our historical track record of adding 6 million in last 2 years, and what we see in terms of transaction volume in Delhi NCR, this would imply around 10% of market share, which we are very confident of delivering on.
Okay, this was helpful. Thank you very much.
Ladies and gentlemen, please press star and 1 to ask questions. The next question is from the line of Ravi Shah from Apple Securities. Please go ahead.
Yeah. Hi, sir. Sorry, I got disconnected. I just had another follow-up question. So I just wanted to know if you can share the status for Max Square Noida 2 project, since we are already halfway through during the quarter. So when do we expect the construction of this to start?
Hi, Ravi. As I updated earlier, Max Square 2, we acquired in October of 2023, and as per our business plan, we are very well within the time of starting the construction in 6 months, which is end of Q4 FY24, and we expect approximately 3.5 years to deliver and receive occupancy cum completion certificate for Max Square 2 development.
Understood, sir. Thank you so much, and all the best.
Thank you.
Thank you. And the next question is from the line of Ritvik Sheth from One Up Financial. Please go ahead.
Hi. Good afternoon, sir. Sir, couple of questions from my end. So what would be the construction spend that we would have done for the Estate 128 project that we launched last year in 9 months FY24?
Hi, Ritvik. Good afternoon, this is Nitin. As of now, on the construction, we would have spent close to 30 crores. This includes the cost we incurred on the experience center and the subsequent construction work which has started on the project.
Okay. And what would be like in FY24 full year, FY25 and 26, if you can give us a figure?
So what we are this entire amount needs to be spent would be in the range of close to 300 to 350 crores to be spent in the next couple of years, and this money would be more channelized from the 70% account which is lying as of now on the project.
Right. So basically, it will be funded from the advances that we have.
Yes.
Sure. Got it. And sir, we mentioned that we are looking to acquire 2 million square feet per annum, and we are close to finalizing at least one, if not two deals in FY25 for acquiring new residential projects. What is the kind of money that we will be spending to acquire these projects, and what kind of GDV would be? Throw some light on that?
Yeah. I think without getting into too many specifics at this stage, I think what will help as a broader guidance is 3 things. One, as far as future acquisitions are concerned, our endeavor is to keep it relatively capital light and aim for joint development and joint venture, and very selectively outright purchase, either bilateral or through auction route. In terms of actual spend, will really vary from opportunity to opportunity, but we would like to state very clearly that for this acquisition, we are very well funded with our multiple sources, including internal approvals, potential to securitize receivables from Estate 128, the LRD on new operational asset, Max House and Max Square. We are very well funded to fund the acquisition as a matter of policy. For these land acquisition, either outright or in the form of deposits that we have to give for joint development, we will be using equity route and not the debt route for land acquisitions.
Okay. But, okay. Any figure like 500 crores per annum we will be spending, or?
I think we would like to avoid that guidance at this point in time. I think what is important to understand, again, from a guidance perspective is, we should look at our CapEx into two parts. Part one is the CapEx that we are going to incur to fully deliver 8 million square foot, the balance of 8 million square foot, which broadly will be in the range of 1,300 to 1,500 crores over next 5 years, well-funded through equity and debt route. So that's one part. As far as newer growth opportunity beyond 8 million is concerned, for those 2 million per year, as I said, that we will be able to share more closer to when we are ready to acquire. But we have a clear line of sight on the source of fund for those growth opportunities.
Okay. So this is helpful, and thank you and all the best.
Thank you so much.
Thank you. Participants who wish to ask questions may please press star and 1. The next question is from the line of Yug Mehta from AP Capital. Please go ahead.
Hi, am I audible?
Yes. Hi, Yug.
So I just had two questions. On the proceeds from sale of real estate projects, how do we intend to use that fund? Will it be for other projects or repayment of debt?
So from the sale of the residential projects, the money is primarily trapped in is kept in the 70% account as per the RERA accounts. And this capital gets released only at the time of completion of the project. So this capital, whatever we receive, will be deployed on these respective assets only.
Okay, sir. So, secondly, sir, on our commercial portfolio, when do we expect to see full revenue potential as Max 2 and Max 65 project is awaiting for construction?
Yeah. So on Max Square 2, as I said, and 65 Gurgaon, both will start construction end of Q4 FY24. Max Square is expected to complete roughly 3.5 years from start of construction. The Gurgaon project will be delivered in 2 phases, delivered in a span of 3 to 5 years, both the phases. So if you go by that, and if you add 18 months post the completion, that's the time when you will get to see full rental potential, which we have projected at 400 to 475 crores. But it will happen over years and not in one go. It will build up over years.
Okay. So thank you. That's all from my side.
Thank you. We would like to remind participants that you may press star and 1 to ask questions. As there are no further questions, I would now like to hand the conference over to Mr. Rishi Raj for closing comments.
Thank you. I hope we have been able to answer most of your queries. We look forward to your participation in next quarter, and thanks to all of you for participating in this conference call, and we will continue our engagement moving forward. For any further queries, you may contact SGA, our investor relation advisors. Going ahead. Thank you.
On behalf of Max Ventures and Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.